Alice, I hope that was helpful to you. And please send your questions at your leisure. We love hearing from you out there. Well, our special guest this evening is Mr. Andrew Benioff from the Llenrock Group, who has a vast level of experience in commercial real estate. Andrew, welcome to the program.
Thank you for having me, Pat. Appreciate
You're very welcome. Why don't you tell us a little bit about, I know you have quite a level of experience and quite a history within different levels of real estate. Tell us a little bit about your background.
Sure. Well, I actually started my career in the luxury hotel industry and spent 15 years in that industry, primarily in operations and finance, and then changed over to the commercial real estate industry sort of halfway through my career about 10, 12 years ago. At Llenrock Group, we are real estate investment bankers and advisors, and we assist our clients who are developers of commercial real estate, owners or investors in commercial real estate, and we help them to assess and underwrite specific transactions to see if they make sense for that client and how to make the most return on their capital. And then we go on their behalf to the capital markets and raise debt, mezzanine, and equity capital for them to complete the transaction. So that's primarily where we spend our time.
And that would lead to the question, as you mentioned, you address the capital markets or enter the capital markets. So
Sure.
for some of our viewers who are maybe less familiar with commercial real estate and how it's financed, what are capital markets?
Capital markets we see as the debt and or equity that you need to complete a deal. Much like when you buy a home, if you're buying a $500,000 home and you get a loan for $400,000
Right.
and you have to put $100,000 of cash in, that $100,000 would be what I call equity. The $400,000 would be what I call debt. So if you're buying an office building, instead of a $500,000 home, you're buying a $50 million office building.
Right.
You would get a $40 million loan and you'd perhaps put in $10 million. Sometimes when the numbers are larger though, the purchaser needs assistance, and so they may have a partner of some sort, a private equity firm, a hedge fund, a life insurance company that would partner with them to buy that and would help to provide a good portion of that equity.
Mm-hmm.
Does that make sense?
So Andrew, the commercial real estate segment, which is pretty broad, I mean, that's a broad brush, has come through a number of up and down cycles. And there was a recent report in the Wall Street Journal, I think it was Deloitte, that did a study on the prospects for commercial real estate as we look into 2015. Could you just talk a little bit about the trends and what you see going forward?
Sure. That's great, Chuck. I'd be happy to do that. Before we go into the trends, let's just take one quick step back and talk about, as you said, the commercial real estate market is fairly broad. So let's define that for a moment.
Yes.
Most people define commercial real estate as office, retail, industrial. We also add in multifamily, which is apartments. And then there are some other uses for buildings. For example, hotel and lodging we add in there, and then some specialty uses like self-storage or student housing. So all of that I sort of encompass as the commercial real estate sector. Trends, as you're saying, things have been improving and improving for a number of years now. As we've gone through 2013, 2014, now into 15, we've had an upswing in both the rents that people are getting and lowered vacancy. So in other words, occupancy is going up as well in most of the sectors, but different property types react in different ways. Some are leaders and some are laggards. Leaders would be the multifamily sector has been particularly hot for a number of years now and looks to be hot going forward as well, with very low vacancies and rising rents. Here in Philadelphia, in the greater Philadelphia area, the mid-Atlantic, Northeast, and across the country, multifamily is particularly strong. Some of the laggards have been particularly suburban office and retail have not been doing as well. Industrial has been doing very, very well, by the way. Looking at suburban office, it's a really interesting sort of narrow case study to discuss because many professionals in commercial real estate sector have thought that perhaps over the past few years, commercial office is a dying part of the sector and nobody is going to go there, why would they invest in it? Because occupancies have gone way down, rents have gone down. A lot of tenants are fleeing to more urban-focused properties because their workers want that sort of urban environment.
Right.
And so the suburban properties, especially the aging older ones that don't have amenities, have been laggards. Some of that is changing now as developers are now trying to add a lot of amenities that urban properties have. They're trying to add them to suburban properties and have been successful in doing so and are getting new tenants back. So that's what we're seeing. I think we're really in the middle of a very strong upswing in commercial real estate in general.
It's good to see this kind of turnaround in the real estate, economy.
Absolutely, absolutely. Real estate's a fairly long-term play. It's fairly illiquid as compared to other investment choices like fixed income or the equities and stock markets, which you can trade in and out of every day. Commercial real estate, you generally can't trade in and out of every day. Matter of fact, you often can't trade out of it for years. So you need to have a longer term view. You need to watch the cycles, as you've just pointed out, Chuck, and I think that's very important.
In a real estate transaction, when you're helping people, and going back to something you said earlier, like let's say a $50 million transaction.
Sure.
To come to the table with $50 million, there's lots of pieces of that. There's, as you mentioned, debt. There's people that lend money, and there's, equity, whether it's, an individual investor or other groups of people that will help that investor.
Sure.
Can you help explain who these different players might be in a typical transaction?
Absolutely. So, in the smaller part of the market, when you're doing a deal that's sort of between $500,000 and $5 million,
Sure.
Generally there's not much choice. You have commercial, sort of regional and community banks, essentially, are the lender of choice. Those are the type of lenders who are lending in those, and there are generally very few, if any, providers of equity or joint venture equity in that space because the check is small.
Now let me interrupt you on that though. With a typical home, as you mentioned, simple math, typically it's a 20% down payment and maybe you can borrow 80%. On the smaller real estate, are those numbers the same or?
Yeah, I think today you can borrow approximately up to 80%.
Okay.
Even on the larger items, you can get there, the larger properties.
Right.
You get there in a little bit of a different way, but I think the community and regional banks are generally comfortable somewhere between the 70 and 80% range. There are some banks lending at 80, others who limit it to 70%.
Okay.
But the equity is usually coming from friends, family, associates, and so forth, because they're smaller equity checks.
Okay.
When you start going larger than 5, and particularly start going larger than $10 million,
Right.
You get more sources of capital out there. Life insurance companies are actually, many life insurance companies have a commercial lending arm. They also often, some life insurance companies have often an equity arm as well. Some of them have both and some have one or the other. So you can, life insurance companies as well as pension fund advisors, usually on stuff that's considerably larger though. Those are deals that are on the small side, 50 million, often 100 or a couple $100 million. There are mortgage REITs. Two types of REITs in the world today, pretty much. I guess you could say there are three. There's property REITs, there's mortgage REITs, and there's hybrid REITs that do a little bit of both. Mortgage REITs are lenders. They're often will do some sort of mortgage lending for commercial property. Mm-hmm. There are private equity funds and hedge funds that are both equity and could be debt. And then there are private mezzanine and bridge funds that have shorter term debt or what we call subordinate debt. So mezzanine financing sits between that first mortgage and the equity that I talked about. It would be sub-debt is what we often call it as well. Mm-hmm. So there are lots of opportunities for capital out there. And then I guess last would be, besides high net worth individuals who might want to invest in real estate directly, there's what we call the family office market, which is very, very wealthy families set up organizations to run and invest their money, and sometimes they have a portion of that investable money to go towards commercial real estate.
So Andrew, different properties have different requirements when it comes to the type of financing. Could you talk about how different properties and structuring financing is going to be different from, let's say, a Class A commercial office versus a luxury hotel arrangement?
Mm-hmm. Sure. It's a very interesting question, Chuck, that you bring up, because sometimes that luxury hotel and that commercial office might potentially have the same lender. There are banks, finance companies, et cetera, out there that only like that luxury sector, whether it's a luxury hotel, a very, very high-end regional mall like the King of Prussia Mall, that Class A office building like we had the Comcast Tower in the center of Philadelphia, or other properties like that. But there are also a number of companies that lend very specifically into different niches of the commercial real estate sector. So there are companies that focus solely on hotels, and there are companies that focus solely on office and retail, et cetera, et cetera. There are also Fannie Mae and Freddie Mac that are quasi-government entities that pretty much focus solely on multifamily apartments, and they do a lot of that. What starts to differ is, are you buying an existing property as a company or an individual that's already up, running, and has full tenancy and occupancy, 90% occupancy, 92% occupancy, that's considered fairly full occupancy? It's a stable property. Well, that's one kind of lender. Are you perhaps buying a property because you see value in it that has lower occupancy, 50% occupancy, where, gosh, there's been some problems with management, or it's an older property, it needs some new paint and carpet and a new roof? A lot of real estate investors like those kind of properties even better. Why? Because they can buy them more cheaply.
Right.
They have the expertise to fix them and manage them well, and they get a much better return in the long run. But it takes a lot of effort. So that's a whole different lender who's willing to take those risks along with those kind of acquirers. And then last type of lender, I'm being pretty general here, there are many other types of lenders as well, but the last general type of lender is a construction or development lender. Well, there's no property, all we have is a piece of land, or we have a building that's defunct that we're going to knock down and build a new building. Well, that's a different kind of lender because they're taking the risk of doing that construction. Right. A lot of lenders don't want that risk. They don't do construction. They only do those sort of permanent loans or exist with existing cash flow. But there is a certain subset of lenders, primarily banking lenders, but also some life insurance companies and others, who will take that risk and actually like that space because they can make a more profitable loan for their company.
So you mentioned returns, and since this is a show about investing, could you comment around the various forms of investment returns? I mean, investors into stocks are typically going to look at dividends and a percentage that's paid on their capital, and maybe some appreciation. In the real estate arena, it's cap rates. Maybe you could kind of define what cap rates are and how an investor needs to size up a particular real estate deal. Sure.
So I would, before I talk about cap rates for a moment, I'd go back and say in the commercial real estate sector, we gauge returns based on risk, like you would gauge a return on sort of any other kind of an investment. And generally speaking, I cut the market into 4 levels of risk, what I call core, core plus, value add, and opportunistic. Core, what I say is, and these, the returns that I'm going to give you are all based on having some level of debt on the property. These are not just all cash purchases. This has some level of a loan on the property, usually a normal level of somewhere between 50 and 75% leverage on the property. Core deals usually, by the way, are Class A, office, luxury. Those are usually throwing off anywhere from a 6 to 8, 6 to 9% type of annual return. Core Plus is usually throwing off of 9 to say 13% return, maybe 14% return. And value add is somewhere between 15 and 20% return. Opportunistic returns are greater than 20% per year. Obviously, as you go up that return spectrum from core, core plus, value add, opportunistic, the risk goes up dramatically. And so you don't want to, 20% plus as a return probably sounds great to many people. but there's a lot of risk involved, and you don't want to go for a deal like that unless you have a good amount of experience and a team that can execute on that.
Andrew, in about maybe a minute or so, what's happening in the city of Philadelphia? Are things good in the city, or maybe it's good for some and not for some others? What's happening in the city?
Commercial real estate in Philadelphia is very strong right now and has had a really significant resurgence over the last few years. I am not a native Philadelphian. I've been here for about 10 or 11 years now. And just during the period of time that I've been here, there has been a huge improvement in the commercial real estate sector here. A lot of activity. Retail is booming right now. A lot of activity on east of Market and east of Chestnut, on east of Broad on Market and Chestnut, excuse me. New Comcast tower going up, brand new Four Seasons hotel, brand new W and Element hotels right in Center City.
Right.
A lot of things happening. The multifamily market is red hot.
And the youth is definitely moving back
A lot
to
of
the city.
and why is all of that? It's
Yeah.
exactly what you just said, which is a huge influx of new residents to Philadelphia.
Right.
You just said you know younger people are moving in.
Right.
I agree with that, but there's also a whole nother demographic that's moving in, which is a lot of what we call empty nesters, and
No.
there are a lot of
I know
older
them.
people moving in. And so I don't know if your wife has been bothering you about moving into the
No,
city.
but we
now
have
and-
friends that actually have.
Right,
Yeah, they
right.
left,
And
they
so-
love, they're not cutting grass anymore. They're moving into the city.
Exactly, and also being able to walk and go out to dinner at night, and you know, I've discussed it with my wife as well, and saying, you know, gee, when the kids are off to college, should we think about moving into the city?
Yeah.
It would save us on all the yard work and other various and sundry activities around the house, but also there's just a lot of activity and things going on here, the arts, restaurant scene,
Right.
et cetera, et cetera. So Philadelphia as a city is doing very, very well in the commercial real estate sector.
Well, Andrew, we thank you. We have to bring you back. I know you have more to tell us, and we've run out of time. Viewers, we thank you for your time and attention.